I don't have the latest figures for the last week or two here. And this doesn't really take into consideration what's happened in Russia fully yet, with Ukraine hitting Russian oil refineries. Russia has been an exporter of refined products, diesel, jet fuel, gasoline. Now they may become an importer, which could further strain the situation. And what's also happened throughout this entire crisis is China has been reducing their oil imports sharply to help ease the strain in the markets. But now they may be re-importing oil again. And as I said a month or two ago, when China makes that turn, it could really put some more upward pressure on the price of oil. So let's see how this all translates. But this is where the rubber meets the road. And this is not a good sign right now. It could get worse, and potentially a lot worse. We're also seeing turmoil in the financial markets, the equities markets. The Kospi, the semiconductor index in South Korea, literally puked this week, dropping from about 67.55 on Tuesday all the way to 52.90 on Thursday, about a 23% drop. Now, this has been a market that's been doing nothing but going hockey stick higher with leveraged retail buying. And a lot of people got stopped out this past week, including Leopold Aschenbrenner, whose hedge fund was heavily invested, leveraged again 4-1 in a couple of high-tech Korean stocks, got stopped out and sold to Ken Griffey's Citadel at a discount price this week. A young investor leveraging up, looking like boy genius, got a real big market lesson this week. But we also saw the Dow take a big hit, especially following the Fed's announcement that they were holding rates steady when Treasury yields spiked. We'll get to that in a minute. Now, both of these markets have recovered somewhat, but volatility is increasing. And I don't think it's any coincidence that this volatility is increasing as we're seeing an expansion of the conflict in the Middle East. More and more of these are becoming more intertwined. And here's a chart of Treasury yields going back since the conflict, before the conflict started, February 2nd. And as you can see off to the right, the Fed held interest rates steady at about 4.62% at that point in time on the 10-year Treasury yield, but it spiked up 13 basis points to 4.75% in the last 3 trading sessions. Fed Chairman Warsh said, we're going to let the market do our work for us. And that's what the market is doing. It's expecting higher inflation, which has remained sticky, and yields are rising further, making the cost of interest for all of us increase. So we're all going to be paying higher interest rates on new loans. And the 30-year Treasury has hit another all-time high yield going back to 2008 now, I believe, which is what most mortgages are based against. So the cost of financing is increasing, and the markets did not like that. They responded by selling off, and we're seeing Treasury values tumble. And the last time we went through an episode like this, when the Fed funds rate went from 2 to 4%, well, what happened? Silicon Valley Bank failed because their collateral, their U.S. Treasury value fell. And this is a similar type of situation. It could create further strains in the financial sector as collateral against loans in banks and pension funds diminishes against those loans. Time will tell how this plays out. But right now, the Fed is letting the market do its work for it, and the market is responding in kind. And what else has happened? Well, the Japanese yen started to tumble, and buying the yen with about $53 billion of funds, probably mostly US dollars. And we had a coordinated response from the US Treasury, which I'm told sold euros to buy yen. Scott Bessent said the yen is very undervalued and excess volatility isn't healthy. And that's what we're seeing. So here's another sign that the unintended consequences of the war against Iran are starting to ripple through into the currency markets. And what happened overnight, Saturday night, last night, President Trump said yet again on Truth Social, as he called off major infrastructure strikes which had been planned against Iran, he says we've got a potential deal. Yet this morning, Sunday morning, August 2nd, off to the right, the Times of Israel is reporting that Iran denies it asked Trump not to strike or agree to a deal to split control of Hormuz. Well, we've seen this one before. The point is, President Trump may no longer be able to jawbone the price of oil lower as we really hit lower tank bottoms and real supply shortages start to emerge. When molecules are actually missing, no amount of jawboning can affect that price. And that may be the point that we're at now. Time will tell. And here's a chart of the yen versus the dollar. Now, we had a similar intervention in April, where over 6 days, the Japanese invested about $63 billion in propping the yen up. And that didn't hold. The yen eroded further, now to its lowest point in a couple of years.
Get weekly institutional grade metals analysis for just $19.97 per month. Donna Samuelson, 46-year gold market veteran and protege of the man who re-legalized private gold ownership in America, just launched a new Substack that helps you stay informed about what's really moving gold and silver. No hype, no price target theatrics, just the clearest read on the metals markets in a format that actually fits your day. Visit news@amerigold.com and subscribe to get this week's full breakdown.